You confidently click Buy on a Forex pair, and almost immediately the market surges rapidly in your direction. But right behind that rush comes a very specific anxiety. You're watching paper profits pile up, knowing a sudden reversal could wipe them all out. To stop stressing, many traders use the back to break-even strategy. Knowing you can no longer lose money offers immediate psychological relief. Relying on this maneuver out of pure fear creates a hidden trap that destroys your profitability. Let's watch the back to break-even move. You take your initial stop loss and slide it up, merging it perfectly with your entry price. Here's the flaw. Markets pull back. A normal dip tags your new stop loss, closing you out, before rocketing to your original profit target. You analyzed the market correctly. You predicted the direction perfectly, but getting wicked out leaves you with absolutely nothing. Protecting capital is vital, but suffocating a trade out of anxiety is not the answer. You have to replace emotion with strict mathematical triggers. Traders often get stopped out at break-even by moving their line too early. They don't give the asset room to absorb normal volatility. This diagram illustrates the 1R rule. R is your initial risk, this bottom block. The top block is an identical profit distance. Don't touch your stop loss until price crosses the upper boundary. Once cleared, the stop loss snaps to entry. You can also use a structural trigger, waiting for the price to break above a major swing high or below a swing low, proving the market's momentum has genuinely shifted. Either way, relying on a hard benchmark removes panic. You are no longer guessing when a trade is safe. You are executing a predictable sequence. Even traders who strictly apply the 1R rule often fall victim to a mathematical oversight. Moving your stop loss to the exact price you entered the trade is not actually a break-even scenario. It ignores the spread and broker commissions. If we zoom in closely on the entry line here, you can see the required correction. The stop loss must be shifted slightly past the entry price, creating a thin buffer to cover those transaction costs. If you ignore that tiny margin, a break-even trade actually results in a small loss. Over hundreds of trades, that oversight slowly bleeds your capital dry. How do you completely remove the painful sting of getting stopped out with nothing to show for it? Institutional traders use a synergistic approach. They combine the break-even adjustment with partial profit taking. The total trade volume is a single circle. When price hits your 1R target, you split it. You close out completely risk-free runner active to capture a long-term trend. From there, you can let the runner work, using a trailing stop to automatically lock in more profit as the price continues in your favor. Stop letting anxiety dictate your trade management. Defend your capital with hard rules. We can see this exact strategy running on the FXNX mobile interface right here, showing a protected trade with locked profits and an active trailing stop. You can test this 1R rule execution yourself by opening a demo account. Mastering the back to break-even move is about discipline. When you stop fearing a loss, you finally give your winning trades the space they need to run.